Monetary policy is the central bank's strategy to control money flow in the economy. It's a set of actions and decisions that shape how much money is available, how easily it can be borrowed, and at what cost. By adjusting these levers, the central bank can influence economic activity, employment, and even the value of the currency. In India, this crucial responsibility lies with the Reserve Bank of India, or RBI, which acts as the guardian of the nation's financial stability and economic health. The RBI uses a variety of tools to influence interest rates and credit, much like a skilled driver uses pedals to control a car's speed and direction. These tools include repo rates, reverse repo rates, and open market operations. The ultimate goal is to ensure stable economic growth, keep prices in check, and maintain a robust, resilient financial system that can withstand shocks. Managing liquidity, how much cash is circulating in the system, is at the very heart of this process. The RBI constantly monitors and adjusts liquidity to keep the economy on track. Too much money in the system leads to inflation, eroding purchasing power. Too little and economic growth can grind to a halt, causing unemployment and hardship. The RBI's challenge is to strike a delicate balance, ensuring there's enough credit for businesses and consumers to invest and spend, but not so much that it triggers runaway prices or asset bubbles. Its policy decisions ripple through the economy, impacting everything from home loan rates and business investments to the prices you pay for groceries and daily essentials. For UPSC aspirants, understanding not just the what, but the why behind the RBI's moves is crucial for developing a deeper perspective on economic issues. This foundational knowledge is key for tackling both prelims and mains with a nuanced analytical approach, helping you connect theory with real-world policy actions and their outcomes. The RBI's monetary policy has four main objectives. First, maintain price stability while supporting growth, the classic inflation growth trade-off. Taming inflation protects purchasing power, but over-tightening can hurt jobs and investment. Second, ensure financial stability by keeping banks healthy and resilient. The RBI acts as lender of last resort and regulates risk-taking. Third, manage the exchange rate to reduce volatility and support trade. The RBI intervenes in forex markets to prevent sharp rupee swings. Fourth, direct credit to vital sectors like agriculture and small industries, supporting inclusive growth. These objectives together foster a stable, growth-oriented economic environment. The Reserve Bank of India, or RBI, wields a powerful set of quantitative tools to control the money supply and steer the economy. These instruments are the backbone of its monetary policy, allowing the central bank to influence everything from inflation to economic growth. The repo rate stands out as the most influential. When the RBI raises the repo rate, borrowing becomes more expensive for banks, which in turn makes loans costlier for businesses and individuals. This helps to cool down inflation. Conversely, lowering the repo rate encourages banks to lend more, boosting investment and spending in the economy. The reverse repo rate, which has now been replaced by the standing deposit facility, was used to absorb excess liquidity from the banking system. By offering banks a safe place to park their surplus funds, the RBI could effectively manage the amount of money circulating in the economy. Another crucial tool is the cash reserve ratio, or CRR. This requires banks to keep a certain percentage of their deposits with the RBI, limiting the amount they can lend out. By adjusting the CRR, the RBI can directly influence the lending capacity of banks. Raising the CRR tightens the money supply, making funds scarcer, while lowering it injects more liquidity into the system, making loans easier to obtain. The statutory liquidity ratio, or SLR, is another requirement. Banks must hold a portion of their deposits in safe assets like government securities. This not only ensures the stability of banks, but also influences how much they can lend to the public. Open market operations, or OMOs, give the RBI the flexibility to buy or sell government securities in the open market. By doing so, the RBI can inject cash into the system when needed or absorb excess funds to maintain balance. These tools, when used in combination, allow the RBI to respond swiftly and flexibly to changing economic conditions, such as inflation spikes or liquidity shortages. Each instrument has a specific role, but together they form a comprehensive arsenal that shapes the entire economic landscape of the country. The RBI's careful calibration and timely adjustment of these levers is crucial for maintaining financial stability and fostering sustainable growth. For aspirants and future policymakers, understanding how and when these tools are deployed is essential for grasping the fundamentals of monetary policy. These instruments form the backbone of India's monetary policy framework, ensuring the economy remains resilient and adaptive in a rapidly changing world. Beyond broad money control, the RBI uses qualitative tools to guide credit flow. Credit rationing sets limits on loans to certain sectors, curbing speculation and channeling funds to productive uses. Moral suasion relies on persuasion. RBI nudges banks to align with policy goals through meetings and guidance. Margin requirements make borrowing for risky sectors harder, cooling bubbles like real estate. These selective tools act like a scalpel, targeting specific risks without disrupting the whole system. They help address sectoral imbalances and prevent asset bubbles. For UPSC, knowing these nuanced tools shows deeper understanding of RBI's role. Since 2016, the crucial task of deciding India's interest rates has been entrusted to the Monetary Policy Committee, or MPC. This marked a significant shift in how monetary policy is managed in the country, bringing more structure and transparency to the process. The MPC is made up of 6 members. 3 are from the Reserve Bank of India, including the governor, and 3 are independent external experts. This unique composition ensures a balanced mix of institutional experience and fresh outside perspectives. The committee's main responsibility is to set the repo rate, which is the rate at which the RBI lends to commercial banks. Their goal is to keep inflation within a target range, currently 4%, with a margin of plus or minus 2%, to maintain price stability and support economic growth. The MPC convenes at least 4 times every year, but can meet more often if needed. Decisions are made by majority vote, and the outcomes, along with the reasoning behind them, are published for the public to ensure transparency and build trust. If inflation moves outside the target range for 3 consecutive quarters, the RBI is required to formally explain the reasons to the government and outline corrective measures, reinforcing accountability. In recent years, the MPC has often chosen to keep rates steady, especially during global economic shocks, carefully balancing the need to control inflation with the imperative to support India's ongoing economic growth. This transparent and accountable decision-making process helps anchor market expectations, providing stability and confidence to investors and the public alike. For aspirants, especially those preparing for competitive exams like the UPSC, understanding the MPC's structure, its mandate, and its impact on the economy is absolutely vital for both exams and real-world financial literacy. Monetary policy, RBI, and fiscal policy, government, are India's 2 main economic levers. Fiscal policy uses taxes and spending to influence demand. Cutting taxes or boosting spending stimulates growth. Monetary policy uses rates and liquidity to influence borrowing and credit. Fiscal actions have immediate effects. Monetary moves work indirectly and with a lag. During COVID-19, the government's fiscal stimulus and the RBI's liquidity measures worked together to cushion the economy. As inflation rose post-pandemic, the RBI tightened policy while the government focused on fiscal discipline. This coordination is key for balanced growth and stability. Understanding their interplay is crucial for policy analysis. For UPSC, linking real-world examples to these concepts is a must. The RBI faces tough challenges, balancing growth and inflation, managing global shocks, and dealing with policy lags. Global events like US rate hikes can trigger capital outflows and rupee volatility, forcing quick RBI responses. Policy changes take time to impact the economy, making timing critical and forecasts tricky. Improving forecasting and clear communication are vital for effective policy. Financial literacy helps the public understand and respond to RBI actions. For aspirants, focus on these evolving challenges and link theory to current events. Mastering the complexities and trade-offs will set your answers apart. The RBI's journey is ongoing, so should your learning be. If this video helped clarify RBI's toolkit, don't forget to like, share, and subscribe. Comment below. Should RBI cut rates in 2025? Let's discuss like future bureaucrats.